I want to build on last week's video and talk about a few things. Number one, not a bunch of news on the economic front, other than the Fed came out last week and really drove home the point that they are going to continue rapidly increasing interest rates through the end of the year, barring any major economic recession. Now, that news shocked the markets because the word major was now thrown into the equation. So recessions do differ. Like anything else, it can be more severe or less severe. Really, the severity of a recession has to do with wages and jobs. So if wages start declining or even stagnate, wage growth, or jobs start being taken away from the economy, basically people being laid off, it can create a more severe recession, which means typically a longer term bear market. Now, the market did briefly, I'm talking about the S&P 500 and the Dow, did briefly dip into bear market territory. Again, that's a 20% drop from a prior high. And that was last Friday. And since then, it has continued to be volatile, but hasn't dipped further back into that territory. Now, what's the market doing and why is it reacting this way? Well, the market in general is trying to predict the future. We talk about the market, we're talking about institutional investors, big money. And remember, the market is simply an auction. You have more buyers and sellers, the market tends to go up. More sellers than buyers, the market tends to go down. Now, does that mean the underlying investments in the market are all bad? No, it's sort of just a rising tide lifts all boats or a shrinking tide shrinks all boats situation. So as time goes on, we'll learn more about what kind, if we go into recession, or what kind of recession we're going to have. So far, if we go into recession, it appears like it might be less severe. Now, what does that mean for long-term investors? Not a lot. Just like we talked about last week. This is an endurance-based game. Investing is a marathon, it's not a sprint. And to enjoy the rewards of 6-7% long-term rates of return in diversified portfolios, you have to go through the difficult times. And it's not fun. It's not fun for anybody. It's difficult and it's challenging, but that's why you get the reward. Risk in life is generally not earned. Reward, is generally not earned without risk. And the risk is the volatility factor. Now, we do diversify. You own, in a typical portfolio, you should own hundreds, if not thousands of companies across the board. And the reason for diversification can really point back to some of the more difficult areas of the market this year. FANG stocks, tech stocks, meme stocks, cryptocurrency. These investments that came out of COVID and just led the way in major returns. And we were often fighting the battle of why don't we shift more portfolio? Why don't we shift more towards what's really doing well in the moment? Because inevitably, what is really doing well in the moment is speculative in nature. And speculative in nature creates more volatility. And that's oftentimes not in agreement with somebody's risk tolerance. So FANG stocks are down over 38%. That's Facebook, Apple, Amazon, Netflix, and Google. Meme stocks, which is AMC, GameStop, Bed Bath & Beyond, and I don't really want to go into why they're called meme stocks, but hopefully you recall, but they're down 77%. Crypto is down 60%, and that's the index, so that's all the cryptos put together. Bitcoin is down over 50% this year. These speculative investments create excessive volatility and often drive very poor results unless somebody has an extremely high risk tolerance. And that's really not who we tend to work with and do best with. So we do diversify. We diversify so we can endure these difficult times. Now, the hard part is it's an unknown how long the difficult time will last. But staying focused and managing the process, which we do for most retired clients, all of our retired clients, the process really drives whether or not we can accept that volatility in the portfolio. Remember, panic creates loss, and we don't want to panic. We want to stay focused. So if you're concerned, if you want to talk more about this, give us a call, 713-977-3800, or shoot us an email. Hope everybody is looking forward to a fantastic Memorial Day weekend. We'll see you next week.